Welcome back to our busy schedule today. And next up, we are joined by Saul Miller of Truffle Asset Management. And Saul is a portfolio manager on our Nedgroup Investments Balanced Fund. Saul, welcome to the studio.
Thank you. Thanks for having me.
I think in the interest of time, we can rattle on to the first question here. I used to be the lead analyst on your fund and used to engage with yourself and the team at quite reasonable depth until a couple of years ago, and the fund was performing incredibly strongly. It's been a bit softer, I guess, with the bull market we've seen in the last 24 months, but notably and optically, if the clients have noticed in the last 3 to 6 months even, it's looking really green in some of our numbers relative to some peers. So I think that's a good way to start, so to see where a lot of that performance is coming from.
Sure. So, SA's obviously come under a little bit of pressure over the last few months. Some of it's obviously due to international markets, in particular the US, coming under a bit of pressure, and we've obviously seen a little bit of drama around our GNU and the sustainability of the GNU. That's obviously been very negative for SA sentiment. So that's also, in addition to what we've had offshore, that's also been dragging some of our SA shares down. So that actually hurt us a little bit, but we did reduce our positions, our exposure to SA companies quite a bit in the prior quarter. So we at least have less of that, but nonetheless we still have we certainly have some exposure to SA, given that it's cheap. But where we did well was particularly offshore. So most of our offshore exposure has been in Europe. We've had quite a lot of exposure to European defense, which is obviously a theme that is doing particularly well now, given what we have in geopolitics and given the need for Europe to spend more on defense. That sector's done particularly well and continues to do well. We've also had quite a lot of exposure to European financials, which are just very cheap, and they've also done well and performed well along with most of the European indices. We've had a bit of exposure to gold as well, which has also helped us, and not unsurprisingly, that's a commodity that would benefit given the current geopolitical tensions that we've seen and the need for central banks across the world to diversify their holdings. Many of them want to diversify away from dollars. That's probably created some of that gold demand.
That gold exposure is on JSE listed gold companies?
That's correct.
Okay. Yeah, in our discussions, with your team in the past and yourself was around, the risk in those long duration US assets, and you guys had an appreciation for Europe. So it's interesting to see how those are starting to, in the last sort of quarter, really show their colors in many ways. As well as the platinum producers locally in South Africa. I think that's been a bit of a turnaround in some of those stocks this year, if you look at who's done well recently. But I know you also wanted to touch on maybe your outlook, based on what you've just gone through now and some of the big themes that you see driving the markets in the near term.
Sure. I've listed 5 sort of key themes that we are thinking about, and I'm obviously happy to unpack any of those themes.
Yeah, well, I think maybe it makes sense to start at tariffs, and you would have been surprised to know that our previous 2 sessions spoke a little bit about Trump as well, and we feel like we're almost political psychologists these days as opposed to market analysts. But with these tariffs, so what are you seeing as underlying motivations behind it? Because I think it's something there's a bit of unease, and we're all trying to make a sense of what is the motion, what is the motives, what is the end game here? Are they in line with US's long-term goals? And what scenarios do you actually see potentially playing out here?
Sure. I think a lot of them are quite misguided, a lot of the motivations, not all of them. Some of the motivations are around reducing the trade deficit for the US. That seems like a bit of a strange goal for the US to have. That trade deficit isn't a sign of weakness for the US. It's because they've obviously had a very successful economy, as is plainly obvious. It's considered the most successful economy in the world for many years, and they essentially have very strong consumers, and they consume more than they produce. So you have a trade deficit, which is essentially structural and not easy to change, and not something you necessarily need to change. What's particularly, I suppose, odd and nonsensical is wanting to not have trade deficits with any country. And that sort of just goes against any of the benefits of that you would get from free trade. There's certain emerging markets where you'll have low wage or people on much lower wages than in your country that will produce primary goods much more cheaply than you can produce them. There's no issue having a trade deficit with those countries. They're poor countries, so they're not going to buy as much from you as you sell to them. Similarly, you'll have some high value goods that you produce as a developed economy that you will sell to other countries where you will have a trade surplus with them. There's nothing unhealthy or nothing odd about that. If you try and balance everyone's trade to a surplus with your country, you will lose that benefit, which we've seen through globalization. You'll lose the benefits of those lower prices that have benefited US consumers. I mean, one of the issues that often comes up is dumping from China. And what often gets missed in that critique of China is that these goods that China produces, they do much more cheaply than other countries. They certainly do it more cheaply than the US, and US consumers have got a huge dividend out of that. Essentially, their disposable income is much higher because things are produced much more cheaply. Now, that doesn't mean, you don't want to defend some of your industries. If an industry has national security concerns, maybe you do want to defend that industry, but there's certainly many industries that you do not need to defend and that are not a national security issue, like shoes. A lot of shoes are made in Vietnam. There's no need to make shoes in America. If there was ever an issue with Vietnam, I'm sure you could fire up a shoe industry, yet they will come under the same pressure that everyone else comes under for tariffs. So there's a lot that's a bit nonsensical and it doesn't seem to be thought through carefully. So some of the critiques are reasonable. Of course, you can defend some industries, but some industries should, they should be taking place in economies that are poorer, and you should be focusing as a developed country on more higher value add industries, and you should be focusing on uplifting and upskilling your own population and making sure that their math scores are above average, that they can engage in those kind of industries where you can add a lot more value than obviously low-end industries.
Yeah, I mean, if I think about back to economics 101 and you're trying to understand, I think, comparative advantages within and across countries. The Economist did a piece saying, Botswana has US has a trade deficit with Botswana. Botswana are exporting diamonds to the US. So it's which the US can't reciprocate. They can't produce their own diamonds. I guess maybe they can do so artificially, but we're not going to go down that road for the sake of today.
No, that's a good analogy.
And then another one that you picked up on was also the US economy has been incredibly successful for a century, if not the envy of the world in many ways in terms of the way they've grown. So to hear Trump saying things like, we've been ripped off by the world, I think it's not really taking that appreciation, the full appreciation for how the US economy has grown on the back of many other countries as well and brought them along for that journey. But also, you're not always going, it's a zero-sum game. You're not going to have a flat trade, account with every single trading partner that you have. Because the US consumer is obviously quite a insatiable consumer.
That's right.
And for that very nature and that very reason, you're going to end up likely with a lot of deficits with many countries.
Right.
And then you spoke about running at a deficit or in debt. Our great South African export, Mr. Musk, is obviously involved with the Doge, the government efficiency. In your view, we say the two Ds and not Donald, Doge and deficit. In your view, do you think it'll be successful? Again, what is the end game here? Is it really around efficiency? And will there be a sort of an economic knock-on effect, at least an economic growth knock-on effect from the projects they're trying to do?
So it's quite difficult to cut the expenditure side for the US. A lot of it is it's essentially social welfare, it's Medicaid, Medicare, and it's social security. That's a huge part of that expenditure. Then you've got interest, then you've got military. Those are very difficult things to cut meaningfully to make a difference. I don't think voters would accept their social security being cut. So I don't think there's a lot of flexibility to do much there. In terms of what Doge can achieve, it really remains to be seen at this stage. I mean, the US is a first world economy. It's not an emerging market which is riddled with corruption and inefficiency. So it's hard to believe that they can really pull out a lot of costs, but we'll wait and see. I think the only lever that will really be meaningful will be one of tax. They're ultimately going to have to hike taxes. Taxes are basically at record low levels if you go back in US history.
Corporate and income.
Corporate and income. For individuals, obviously you get more tax from individuals. You're going to have to increase taxes to higher levels. I don't think at these low levels of tax, if you cut tax further, you're going to get an offsetting growth benefit that feeds into higher tax. You need to have fairly high tax levels for that to happen, which is what you don't have that in the US currently. So they're going to have to swallow that very unpleasant pill. And that will obviously help bring the deficit down, and that will be negative for growth, and it'll be painful for the economy. So that is a headwind for the US. And whether they take that pain now or later, at some stage, if you look at the various forecasts that are provided, they're going to have to do something.
And I think, as the US moves between Democrats and Republicans, I mean, the core philosophy of Republicans has been largely around less government. That's their conservative politics there and the way they approach things. I think we haven't seen it as this much less government than we've seen in the past. But a lot of this onshoring has an effect and I want to go back to the European side, because we didn't chat about that much with our other speakers before. I maybe touched on it, and you spoke a little bit about the banks. But I mean, what does this mean in terms of the impact on maybe European equities, for example? I mean, how reliant are they on the US?
Europe's got some positives. They obviously are hit by the trade war, so that is a bit of a negative. But what's particularly positive for Europe is obviously this need to spend on defence is obviously is going to provide some stimulus. But more than that, Germany is also going to have quite a lot of stimulus in terms of infrastructure. We're looking at €1 trillion of infrastructure and tech spend in Germany, which should be particularly positive for growth going forward. I think the actions of the US has almost forced Europe to kind of look a little bit inwardly and try and work together more. And I mean, they have been taking notice of obviously the huge inefficiencies that you have in Europe. It is overly regulated. You've had these reports that have come out. One of them was from Mario Draghi about how inefficient and how overregulated Europe is. And I think to survive, they're going to start cutting back on those regulations, and you're already seeing evidence of that and acknowledgement of that. So I think that's also a positive for Europe going forward. The market in Europe also looks pretty reasonable when you look at valuations relative to history. So I think there's some real positives for Europe going forward.
Yeah, it's interesting you said they're going to be a bit more inward looking. We had Walt Aylett on earlier, and he even made the observation of Britain might, have a change in their strategy with Europe, might become closer again, despite, the Brexit vote that we saw. Was it almost a decade ago now?
I think that's very possible.
Yeah. And then China, their position in the world, this could force some sort of change in their stance. They might take the lead in certain areas where maybe the US were taking a lead before. Again, from a strategic point of view, what do you think? How are they looking to play this?
China's a difficult one. They are going to be hurt by the trade war. I mean, unfortunately, we don't know how that's going to play up. There's a lot of uncertainty around where tariffs are going to land. There's been a lot of backwards and forwards just from day to day. The US has changed their position on what will be tariffed, what the amounts will be. Assuming something draconian remains, it looks like if there's one area where they might struggle to get a deal, it would be with China, and that'll obviously weigh on China because China does have a lot of exports to the US, so there certainly is some pain for them. On the positive side, we've seen some really positive developments in China over the last few months. I mean, for me, one of the biggest ones was this embracing again of tech CEOs and bringing them into the fold. Obviously, a realization that you need to encourage big tech if you want to be a superpower. I think that's hugely positive. It's positive for investor sentiment, which is also probably positive for consumer sentiment, which is an area that China really struggles. They have these very high saving rates. Consumers don't spend. So I think that arguably trickles down there a little bit. But also importantly, we've had DeepSeek, which also shows that the Chinese really can compete in high tech, which is also another positive for China. So there's some internal, in terms of what's happening internally in China, I'd say there's some real positives. They do have some structural issues around low consumption, but that's in the base, and they've obviously got this trade war. So pros and cons. I mean, the way we sort of deal with that is we certainly have some exposure to China. Valuations are reasonable, but we do have to temper the size of those investments given the uncertainty that they're facing around tariffs. We used to be worried about internal uncertainty like regulatory issues. That's almost toned down a little bit. We actually feel better about that now. It's more what happens with
sounds like they're almost going down the journey of maybe more market-friendly behavior internally, trying to encourage that entrepreneurial spirit, which I think the tech industry is giving them on many levels. Another thing we've noticed recently is they've also diversified their trading partners. They may be not as leveraged on the US as they might have been in the past. And on one of their trading partners, I guess we are one of them. So bringing it home here to SA, you know, a lot of the headlines we read on targets for 2% GDP growth, etc. I mean, is this something that's actually realistically attainable for us?
Less so than we thought last year, towards the end of last year. I mean, first of all, we're dealing with an international economy that's looking a little bit worse off, given what we're seeing with the trade wars. So that hit to the offshore economy does filter through to SA in terms of what it means for demand for commodities, what it means for tourism, that we're also, obviously it's also a key driver for our GDP. So those things look a little bit more negative, but probably much more important than that is really what's been happening with the GNU. And the infighting there has obviously been hugely negative and concerning. If you're rational, you would think, it's in everyone's interests, for all parties, for this GNU to hold. In other words, for the DA and for the ANC. That's if you're being rational. What we've seen has certainly been negative, has weighed on SA sentiment, and has probably hurt, our fixed income market as well a bit. Hopefully, that gets sorted out. I mean, other worries that we have, post the budget is, you're not seeing enough of a focus on GDFI spend, and we need more investment in fixed assets in this country. We spend less than almost most countries in the world, and if we're going to be prosperous and we're going to have a higher GDP, we need to invest in fixed assets, and we're not really seeing that. So that's something which I think which has to change.
And when you say investing in fixed assets, you're talking about at government funding? We're talking about private sector funding?
Both. It needs to happen in both. We are seeing some positive moves. As you know, we're seeing some positive moves from Transnet, which is positive, but it's going to take time for those. We're going to import those locomotives. We have to fix railways and so on. So hopefully that happens, but it just seems a bit pushed out.
Well, let's hope we import the right size locomotives this time that fit our tracks. We are running short on time, but I do want to touch on this. I think give a last slide just around some of your positioning in the portfolio. I guess, given everything that you've said, it's also trying to separate the global noise from the local noise. What's driving local market share prices? What's driving internationals, for example? Would you say, is it a fair comment to say that you're relatively defensive, given everything that you've spoken about for the last 15 minutes?
Yeah, I think we've been reasonably defensive. We did reduce our equity exposure into the end of March. We also put protection into the funds where we protected 10% of our equity, and that protection is kicked in at these levels. So that also provides extra level of defensiveness. And we reduced some of our SA exposure earlier on in Q1 as well, after that great run in SA assets. You've obviously seen them sell off quite aggressively. So we've once again been looking at SA assets. Although GDP growth looks like it might be a little bit lower than we would have expected a couple of months ago, we still think that valuations in SA are particularly generous after the fall that we saw recently.
Saul, thank you very much for your time. As always, we enjoy hearing from you, and I'm sure everyone that dialed in agrees with me. I love reading the Truffle quarterly commentaries. I think you guys are really good at painting a nice sort of holistic picture on all the major economic indicators and reasons behind what we're seeing in the world. So thanks again, and we'll catch up with you next quarter, and I believe we have a short break before our next guest. Thank you.